cocktail sessions, educational and inspirational talks from experienced startup founders, entrepreneurs, and thought leaders.
So I actually brought my dog with me, and so as I've been walking around the hotel or the Ogden or whatever, everybody asks me about this dog, and they're like, "Oh, it's Boo," and I'm like, "No, it's a motherfucking bear, is what it is." And because that's the only way I can kind of maintain my manhood with this eight-pound dog running around. But anyway, so again, my name's Paul Singh. I am. I guess cursed with this problem of thinking about the private markets a little bit too much, and. The reason I do that actually is that a couple of years ago I sold a company, and I started thinking more, one of the companies I started, and I started thinking a lot about how you track companies in the private markets better. And this, I promise it'll make more sense later on here, but just walking through the story, started building dashboard. A few months later actually, I joined Christine Tsai and Dave McClure as the first three partners at 500 Startups. And that's been around for about 2.5 years now. We're up to about 25 people now, but in that time, I either directly invested or my team invested in about 450 plus companies in 30 countries. And so sort of the half-joking, half-true statement is that about every 3 days we make a new investment somewhere on the planet, and we've invested in about 30 countries. And then, as Frank said, I'm an EIR at the White House and Homeland Security and Citizenship and Immigration. I've actually, as an aside, learned that politics and venture capital are very similar. You lose your friends as soon as you become one or the other. But anyway, so what I want to talk about is just a couple quick ideas, and I'll bring it all to a head here. But the first thing, so regardless of whether you're on the policy side, in the government, or you are a founder or an investor, I think one of the things that we need to understand is that the companies, the big companies of tomorrow, do not look anything like the companies of yesterday. And if you don't believe me, then what you should do is just look at the dollars of revenue per employee at places like Amazon or Facebook, and compare them to the large companies of yesterday. Right? There's not going to be 100,000 person companies that often anymore. There's only so many, Lockheed or General Dynamics are going to come around anymore. And this is important because I think we should stop calling these companies startups. We should actually start calling them the tech-enabled small, medium, and large businesses of tomorrow. And I think if we can reframe, I know it's just a play on words, but if we can start thinking of them that way, we start to realize, or at least remember anyways, that this is how we're going to save America. This is how we're going to ensure our own economic development and job creation, is that it will look very different tomorrow. So the second thing, so that's the first idea. So the second idea is the public markets have been evolving for 50 or 60 years, if not longer, and the private markets are already evolving. So just as an example here, so in the 1950s, the average Fortune 500 stock, of common stock, was held for how long? Does anybody know? How long, in the 1950s, how long was a share of common stock in a Fortune 500 company held?
35 years.
20 years.
On average, it was about 6, so you guys are very conservative. I'm sure you save a lot of money, that's great. But it was 6 years, and by 2000, that dropped to about 6 months. Right, and now in the 2010s, what do you call this decade? It's on the order of seconds. And the thing is at that pace, the public market volumes tend to double every 4 to 5 years. And what the underlying trend that's really important to keep an eye on there is that we went from an entirely paper-based trading system, that's what NASDAQ and Wall Street fundamentally was, to an electronic trading book. Right? So today you've got high-frequency trading and all sorts of stuff. You guys can just go on E-Trade right now on your iPads and buy one share of X and sell one share of Y. That didn't exist 10 or 15 years ago. But the private markets are just now starting to see that. And that's probably big thanks to companies like AngelList, and there's many others now that are trying to do the same thing. But the point is, though, is that like when AngelList started their Invest Online, there's a little button on there now called Invest Online. You press that, you can just look at their blog, and they'll show you that millions of dollars a month are being traded in the private markets by private investors in private companies. the markets, that buy side of the private markets are getting more efficient. Just like Ariel just said a moment ago, money is becoming commoditized. It may not feel that way to many of you, but when I started my first company 15 years ago, it is way easier to raise money today than it was back then. So the core idea there that I want you to just understand is that we're moving from, the private markets are moving from a paper-based or email-based trading system to electronic platforms. And that means there's more access for everybody. And for, if you want to read more about this, just take a look at the stuff that's coming with crowdfunding. It's just going to blow your mind. By the way, as an aside, I'll just point out that I think, you know, it's funny, when people talk about crowdfunding, they always talk about how Joe the plumber will be able to get access to the next Facebook. And that's probably true. But I think the thing that we don't talk very often about, and I don't know if it's because we don't care or because it's just awkward to talk about it, is that when the platforms become electronic, what ends up happening is the traditional VCs, they're still playing in there, right? And then the bottom of the market gets flooded by these retail investors, these new crowdfunders at the bottom of the market, right? And at the top of the market, it's the LPs that come in. So in other words, the people that used to give money to VCs, if the markets are electronic, those LPs can now trade directly in the private markets. And I think it's really fascinating because it's going to put a lot of pressure on VCs to adapt. And it'll just be really fascinating to watch. So that's the second idea. The third idea is that the markets are becoming more transparent, right? So for, actually, so I spend a lot of time on the road and I end up reading a lot. One of my favorite research papers is in 1970, a guy named George Ekerlof wrote a paper that won him the Nobel Prize called The Market for Lemons. And what he actually did was, it's this long, crazy paper, but fundamentally what it, if you boil it down to like 1 or 2 sentences, really what he talks about is that he makes a case for opaque markets, markets where there's asymmetric information devolves into desperate buyers and gullible sellers, or vice versa. The point is, it's not an efficient marketplace. And you can see this like based on even what Ariel was saying, and I can kind of echo that too. When I was starting my company, my first one 15 years ago or so, there was no transparency. You didn't know what a good term sheet was. You didn't really know. Nobody was really talking about this online or anything like that. But the markets are getting transparent. So as those markets get transparent, what I find really fascinating is that if you think about the way the public markets work today, right? So the public markets today, I believe, fundamentally are regulated by fear and greed. And those two things operate in what's called a negative feedback loop. So the best way to explain this is just to give you an example. If I own a share of Apple stock and I don't like the earnings report that just came out, if my fear index is higher, I can then post that share for sale, or that share for sale, and one of you will have a higher greed index than I will, and say, well, I'll just buy it low and then sell it high later on. And because there's a lot of buyers and because there's a lot of sellers, those fear and greed indicators run as a negative feedback loop, and for the most part, they regulate themselves pretty well. And you know, sometimes when there's an excess of fear, we call it a depression. When there's an excess of greed, we call it a bubble. But those things regulate each other for the most part. In the private markets, what's really fascinating is today, those things operate in what's called a positive feedback loop. And you can kind of see that because what will happen is that investor A will introduce a company to investor B, right? And then investor B says, well, if investor A is into it, then I'm excited about it. So fear and greed operate in lockstep. But the minute anything goes south, everybody goes negative on the company. And as the markets become more transparent, I believe that what will happen is that the private markets will switch from being a positive feedback loop to a negative one. Does that make sense? You guys either hate this or you love it. I'm going to go with the latter, but so here's the thing. So the summary of all of this is that the private markets are already evolving. They're already becoming efficient, and I believe that soon they will become liquid. I think that within the next 3 to 5 years, we're probably going to start seeing things on the news about some sort of ticker showing some sort of indicator on the private markets. And because of all of that, because of all of those little ideas there, I think that this decade will be remembered as the rise of the angels and the rise of the entrepreneurs. Thanks.
Question? Good job. We're going to do some questions here. So, who's got the first question? Right here. Okay.
I'm surprised nobody heckled. Nobody did anything.
I thought about it. I just never did it.
So, do you feel like the liquidity is going to come from the second shares and all those markets? And the second part of it is the framework of Series A preferred, Series B, and the waterfall that currently exists, do you believe that it will continue to exist, or it will be sort of everyone's buying in common?
Well, okay, so there were two questions there. I think the first thing is that if we can get more buyers onto the platform, so let me step back. So the markets, the buy side of the transactions are already getting efficient, and we know this because if you make yourself available to invest, if you hit that little invest button online, Pivot Desk can raise money online, right? So you now have an efficient marketplace where a lot of investors now have access to your business. As more and more crowdfunding stuff comes through, you will have even more potential buyers. On the other side of that transaction, the sell side is still not efficient. So for a lot of reasons, mostly because of a lot of the regulation around the sale of equity, it's very hard for you to sell. But on top of that, there's not very much understanding in the general public about what these shares are worth, how they're structured, things like that. I think what you're going to see from the SEC and other people is going to be a standard reporting framework. It'll be a little ugly at first, as usual. But I think what will end up happening is that sell side is the next big regulatory battle. That will, once that side is efficient, once you have a buy side that's efficient and a sell side that's efficient, that entire market becomes liquid. And in plain English, what that really means is that if I invest in your company early, and then let's say you're going into a Series B, right? So like let's say the multiple growth of your company in terms of valuation's gone up, 100x by that point. As a VC, based on the economics of my fund, I might decide that, well, I think there's only a 10x growth multiple left on this next round. I'll pass. But I'm sure there's somebody here that would say, boy, I'd invest $100,000 to get 10x on that, because you're already doing it in the public markets. Whether you realize it or not, when you actually set up your 401k, there's somebody managing your money and betting it on the public markets, and some percentage of that is going to VCs, believe it or not. I don't know if that's good or bad. You're either really scared now or not. But so the point is, though, is that I think directionally I'm right about that. The timing is the real question now.
Then it would wash the need potentially for AB, waterfalls, preferences, all that.
So I try to steer away from anything around the idea that like VC's in trouble or that traditional models are bad. What I'm just suggesting is that when you have a transparent and accessible private market, more players can play. Right now, you're only able to raise money from a few. It's N number of VCs or super angels. Right. And I think what changes is a lot more players come to the table, and now you as the founder have a lot more options. There will always be a need for a Sequoia. There will always be a need for a Techstars. Now, the thing is, the private markets will give you the choice to pick who you want to in your company.
Give me the choice and the security that I want to sell.
Yes.
Which could lead to more different standards.
Right.
Even for Sequoia.
That's right.
Right.
Back here in the back. Whoa.
Hey, Paul.
Hey, man.
Hey.
You look really familiar.
Yeah, India.
Oh,
Hey, good to see you again.
Out of 1.3 billion people, I do remember you, yes.
We work together. But actually, you had a good question about, you had a good point about crowdfunding and how
Just one? Come on.
About many points about crowdfunding and Kickstarter and things like that. And I think probably maybe a third of 500 Startups portfolio is outside of the U.S.
Probably a little bit more than that
Maybe
now.
yeah. So, I get asked this question a lot, whether it's going to happen in other markets, for example, India. And I'm not sure because the trust level is just not there in other countries. The legal system isn't there, and there's a lot more, potential for fraud.
Yeah.
So I wonder what you think those things can be, other parts of Silicon Valley are being moved to Bangalore or Shanghai. Would that ever happen?
Well, I think, so I'll say two things to this. I would say, number one, the international markets are far more appealing to me than the U.S. markets. In many ways, I feel like Mexico, Brazil, and India look like America did 15 years ago, where you have rising credit card penetration, rising internet penetration, rising everything else. But that problem with like corruption and legal frameworks does exist. However, I do still think, even with that, it's a net win. It's actually less worse to put your money over there than it is in many US markets, and that I'm not trying to not be a patriot or anything like that, but the point is, though, is that I think that those markets are very interesting. I think the second thing, though, is that, and maybe I'm biased because of the deals that I've seen, but many, not all, but many of the companies in the international markets that try to go after venture funding do set up a holding company inside the United States anyway. So, I don't know what will happen to the international markets in terms of that, but I do know that if we look at the data, many of the IPOs are more likely to happen here than elsewhere. So I feel pretty good. So again, the point is, I think investing in the international markets is great. You just need to know what you're doing. But when possible, try to make sure you structure it as a US deal, because you have the highest chance of follow-on capital and possibly liquidity from this market.
We're going to go 2 more questions. I already ran through the stop sign. We're supposed to cut it off, but there's some questions here, so we're going to get those answered.
So, Paul, what do you think when more players start playing, as in more investors across the broad spectrum start investing, how do you think the dynamics of mentorship and board of advisors and investors trying to control where the entrepreneurs should go are going to change?
Well, I think there's a couple things in there, and I'll try to keep it brief. But I think, first of all, for those of you that have a board of advisors, go home and get rid of it. Like, it's ridiculous. The point, like, it's ridiculous. What did those people ever do for you? So here's the thing. Now, I'm not saying you shouldn't have advisors, but the notion of board of advisors makes it sound like you've got this council meeting, and it's just not a good idea. So, like, even Dashboard has 2 advisors, and I call them when I have specific questions, and then when I want to, like, have a drink or something. But that's actually half true, half joking, but mostly true. So the thing is that control. So now the thing is control is a really interesting thing. So I think the function of the board of directors is mostly forgotten. Meaning, we end up setting up boards of directors in the early days for many reasons that we think are related to, like, keeping the company on track, whatever else. We forget that the purpose of the board is governance. Now, this is a double-edged sword. I believe that that if your company is going sideways, just drive it into the ground. My time as an investor, and all of your times as investors, is better spent looking for a new investment, not trying to save one that's going down the drain. That's sad, but true. Here's the next thing, though, and I promise I'll end this, is that, like, the venture capital is really fascinating because for the first 50 years, 60 years of venture capital, the VCs differentiated on capital, deal flow, and judgment. Right? Those 3 things were about credibility. So it's either I'm managing this much money, right, capital, or deal flow is like I'm in this region, so look at all these things I can see, or the judgment is like I'm Harvard, or I'm Ivy League, or I'm ex-SAP, or whatever it might be. Those things are table stakes now. I think what you're seeing in the industry is that many VCs, either knowingly or unknowingly, are realizing that notability matters more than credibility. And so in other words, access to deal flow matters, and mentorship matters, but it's not often the VC that gives a mentorship, it's mentor networks. And if you don't believe me, just look around at any VC now, you're going to see a mentors page, you're going to see these office hour kind of things. And I think what we're doing is moving from a strategic hand-wavy VC meeting to a tactical, results-oriented, mentor-driven meeting. And these mentors are typically like full-time operators in some specific verticals or areas that are able to answer tactical questions. So here's the summary of all that. If I were to raise money a year from now, or even now, I would rather have like the person at Zappos that's running search engine marketing give me $10,000 than to have like some senior manager at IBM give me 100. That's how serious it is. I mean, I think that $90,000 difference is worth the tactical expertise with online distribution.
So that was the short version.
That was a short.
Okay.
Yeah, the funny thing about being a VC is that, like, we're wrong 99% of the time, and people still listen to us.
All right, one more question. Lightning round. And thunder round, too.
Yes.
Thanks for speaking. So I think you kind of buried the lead. You said you think when LPs start investing on their own and not having to go through VCs, it's really going to change how VCs act. I'd love to get your sense on how you think VCs are going to change. Some have prognosticated that, there's going to be at least one partner who's devoted to, running the second market stuff. How do you think that looks in 3 to 5 years if that market becomes more liquid?
All right, two things. I promise I'll keep it tight. Number one, I think within 5 years, every VC will have at least one partner responsible for electronic trading. I think number two, VCs today raise money on access. So what we say is we go to a bunch of people and we say, you want to invest in the private markets, you and I both know that. I'm the guy because I have all the access, so you're going to pay me 2% per year to just do that. I'm just the middleman, right? And that's literally what it is, right? I mean, fellow VCs, I'm kind of outing us, I suppose, but that's sort of how it is. I think what that means for the future is that our models are going to have to change. Our sales pitch is not about access anymore, it's about service. I think you're going to give me, some portion of your assets to manage if you just don't want to do the work. And you're going to see me as a service provider rather than the actual channel. So, awesome. Thank you, guys.
Thank you, Paul. Let's hear it for Paul Singh. Thank you so much.